Our second feature this week is with our team from Oasis Crescent Advisory Services, Ebrahim Rawoot, Mansoor and Salima Mocack. And the focus of the discussion was around wealth building or wealth management, but very importantly also discussing key issues and concepts such as inflation and diversification. This is what they had to say. Ladies and gentlemen, Assalamu alaikum wa rahmatullahi wa barakatuh, and welcome to the Oasis Focus on Finance show.
Wa alaikum salam wa rahmatullahi wa barakatuh.
Now I think today obviously our focus is going to be on demystifying investments, making it simple for the viewers to understand what is this world of investments that we're living in. Now, if you look at investments, there are key concepts that hasn't changed over time. Yes, over time, investments has evolved, like technology has evolved, things do evolve over time. But there are certain key concepts that stays consistent and constant throughout time. And I think starting off with one of the most important aspects which every investor should understand is inflation. Yeah. Ebrahim, maybe starting off with you. What is inflation and how does it impact the ordinary investor out there?
Hassan, inflation refers to that persistent increase in the general price level of goods and services over a period in time. So when the general price increases, so that unit of currency is effectively buying you fewer goods and services. So what inflation is really doing is eating into the value and the purchasing power of one's wealth. So how do you best explain it? Let's use a basket of goods. I have 100 Rand. I walk into a supermarket and I buy bread, milk, sugar, rice, and maybe some vegetables. But now, in 2014, I take my 100 Rand and I fast forward myself to 2020. So for the next 6 years, inflation at 6%, effectively my 100 Rand in real terms is now worth 69 Rand. So if I want to go back to the supermarket with my 69 Rand, I can only afford to buy bread, milk, and sugar. Look at all the other items that has fallen off the basket. And that is the effect that inflation is having on one's wealth over a period in time. You don't see it, but it is certainly eating into that value. Listen, so many people leave money under the mattress. So many people leave money in a shoebox or in the cupboard, or they leave it in the bank account and they don't want to earn the interest for reasons of moral beliefs and religious rights. But in all those examples, that 100 Rand is still 100 Rand today. It's going to be 100 Rand 5 years from now. It's going to be 100 Rand 10 years from now. But look at what the effect inflation will have on that 100 Rand. So we need to be ensuring that our money is invested wisely, correctly, to protect against the harmful effects of inflation.
Well, one, I think, definitely cannot underestimate the impacts of inflation. And I think, it's probably like that silent thief at night that comes and steals and erodes away your wealth. Mansoor, how does maybe one protect themselves against the impacts of inflation? What assets are there that they can invest in that can protect themselves against this?
So there's a number of assets one can invest. Maybe just to add on from where Ebrahim's coming, that individual that keeps money in the bank account, one, they don't want to accept the interest. There are other alternatives. They could look at the Sharia compliant income fund, which would be the first asset class that they could invest money into. But what's the income fund giving you? Probably giving you a return of about 6.5, if you're lucky, 7% return. All it's doing is covering inflation and maybe adding a half to 1% on top of inflation. It's not an investment where you're going to put long-term money in. That product, I would say, money that Mansoor, I'm going to probably use this money in 6 months to 12 months, to even 18 months. There is a need for this money in the short term. Ideal product to park your money in. At least you're maintaining your purchasing power. You're not losing or destroying your wealth where inflation's eating away at it by 6%, you're maintaining your purchasing power of your money. The other two asset classes that I believe is an asset class you cannot afford not to invest in would be your equity, which is the stock market, and the property sector. If we look at equity and property sector over the last 10 years, they've delivered significant outperformance compared to cash. That's in the income product giving you 6%. Property has given you a yield of about 12.3, 12.6% annualized over the last 10 years. Equity has given you roughly 16, 16.4% over that same period of 10 years on an annualized basis. Yes, with investing in equity and property, there is the risk because it does fluctuate. Look, markets are always going to be there. Markets are always going to fluctuate. They're going to go up, they're going to go down. For me, the biggest concern is inflation. You need to have your money in a product where you know you can cover inflation and add value over time. If you take 2008 economic crisis, yes, stock market lost 38%. A pure equity portfolio lost anything north of 20%, 20% plus. But fast forward, as Ebrahim says, 3-4 years later, 2008 to we currently in 2014, you recovered the 20% you lost during that downward trend of the market, and you're showing probably 30 to 40% more return than the 20% that you've lost. So it is very important to expose your money to an investment that is linked to an inflation hedged or giving you an inflation hedged return, like assets, like equity and property assets.
Sure. So I think one of the points you've highlighted is obviously looking also at investments from a long-term perspective. Salima, maybe coming through to you in terms of investing and looking at it from a long-term perspective. You know, a lot of people tend to look at things short-term in nature.
That's right.
How important is looking at investments from a long-term perspective?
Hassan, investors generally have the nature of wanting to invest for a short term in order to obtain the highest levels of growth. It's often said that it's time in the market and not timing the market that yields the best returns. If I could use the analogy, it's about a farmer who farms organically, takes time in nurturing his harvest, and it produces an excellent yield, an excellent crop, as opposed to genetically modified harvests where we rush through the natural process, and all that ends up happening is that we have a bad crop, bad quality. It results in ill health and a bad quality of life. So essentially, it's about remaining invested in the market throughout the investment cycle. As Albert Einstein once referred to the compounding effects as being the eighth wonder of the world.
Sure. Maybe, Ebrahim, just in terms of compounding, just sort of breaking it down for the viewers out there in terms of, you know, how significant can the compounding effect be in the life of an investor?
Yes, Salima mentioned, the analogy of the farmer, and, if we just use a very simple example of 100,000 Rand invested today, and let's assume a 10% return, 25 years, you do the calculations, that 100,000 is going to be worth 1.1 million Rand. But now use that same example of 100,000 Rand, 10% return, but instead of 25 years, we add 10 years, 35-year period. Do you know what that value is worth? 2.8 million Rand. So you have an additional 1.7 million Rand of wealth only by having invested for the extra 10 years. And that is the effect that compound is going to have on your investment. And that's why Salima so rightfully said, it's about the time that you spend in the market and not timing the market.
Absolutely.
So it definitely has in terms of quality of life impact. The person who's there longer term, obviously the benefit to them, their families, obviously is substantial as well. Coming to another important aspect in terms of investments, diversification. Now, the concept that always goes around is do not put all your eggs in one basket.
Yes, we've heard that.
Now, maybe Mansoor, in terms of diversification from an investment perspective, what are the key aspects around diversification?
Hassan, rightfully so. I think you're absolutely right in saying that diversification is spreading of your risk of your investment. But using the example of not putting all your eggs in one basket is the same as an individual taking R1 million, investing it across 3 fund managers into 3 different Sharia compliant equity portfolios. For me, that is not diversifying your funds, because ultimately that investor is exposing his money to exactly the same stock market. Yes, each of the fund managers have their own stock selection, but you're exposing your money to exactly the same asset class, and that is equity. From an investment perspective, I think diversification is much more broader, and there's actually various levels of diversification that one must look for when looking at an investment product. The first one I would say is asset diversification, where you're exposing your money to equity, property and cash. Then you've got sector diversification, which is the various sectors within the equity market, within the property sector. Currency diversification, where you're exposing your money to various currencies, and geographic diversification. In fact, you can probably add a third form of diversification, which is instrument diversification, Hassan.
Sure.